Hello all, and welcome to Consumer Goods Night hosted by Inderes. My name is Thomas Westerholm, and I cover consumer goods companies at Inderes. I will be hosting a small keynote presentation about the industry more broadly, after which we will hear two presentations by two consumer goods companies later on, Marimekko and Orthex. As a reminder to all our listeners, after the presentations, we'll be having short Q&A sessions with the companies, and you're free to post any questions already during my presentation. But without further ado, let's dive into the topic of today. If we look at the Helsinki Stock Exchange and the listed consumer goods companies here, I usually like to separate them into two categories. Consumer staples companies, which produce and deliver products that are usually consumed, and hence their consumption is more stable. And then we have consumer discretionary companies, whose products are have a longer lifespan and are hence used for a longer period of time. If we think about our consumer staples companies, we have a rather broad supply of them. For example, beverages produced by Olevien and Nokian Panimo, fish farming in the form of Fifax, meat production, Atria, HK Foods, plant-based food, Appetit Raisio, alternative protein sources, Solar Foods, ready-to-eat meals and snacks by Fodelia, and wine and spirits by Anora. Today we'll, however, be focusing more on the second category, consumer discretionary companies. Here we have companies like Marimekko that produces clothing and accessories, home storage solutions by Orthex, fireplaces like Tulikivi, fishing equipment manufacturers like Rapala, indoor and outdoor living products from the likes of Fiskars, sauna category, as in Harvia and somewhat Tulikivi, and also Nokian Tires that produces tires. But some things investors like about these consumer goods companies is that usually they have rather diversified customer portfolios and geographical diversification. Hence, they're not too reliant on a single customer or a single market area. Also, strong brands usually enable excess returns on capital, and hence the operations and growth is very profitable for these companies. Also, the industry comes with barriers to entry. It's hard to start to compete with some established players with strong brands and large production facilities. Also, from an investor's point of view, getting to know these companies may be a lot of fun, testing out their products and seeing how they work compared to competitors, for example. But if we think about the value chain of a typical consumer product company, these companies produce their products and then to a varying degree utilize wholesalers, retailers, and some go straight and sell directly to consumers. If we think about our companies presenting here today, Orthex, for example, relies heavily on their retail partners, whereas Marimekko uses a more hybrid approach, using retailers but also direct to consumer channels. But also thinking about these companies' supply chains, I feel like the last few years investors have paid special attention to even further upstream to where the products, the raw materials, and some other inputs come from, since these political tensions have made investors rather aware of, geographical linkages. But what should one look for in a consumer goods company? A strong brand that resonates with customers is usually a good starting point. However, some well-known brands do not lead to consumer willingness to pay. As investors, it's our duty to actually try to figure out, does this company have pricing power despite or although they have this strong brand? Sometimes consumers aren't willing to pay for a brand that is very known, and hence the company's financial performance might be hampered due to it. Another thing is economies of scale and scope. How efficiently does this company produce or source its products? There's massive differences between the most efficient production plants and the less efficient ones. So investors have to dive deep into how efficiently the operations are run in a company. But also balance sheet strength is vital. If a company has a strong balance sheet, it enables the management to just focus on growth, but also gives extra leeway for capital allocation in the form of dividends, but also M&A opportunities. And last but not least, sales and marketing capabilities. These are essential even if the product the company manufactures is superior, because how would the consumers else get to know of this well-functioning product? Here we have some macro drivers that investors investing in consumer goods companies should keep an eye on. Consumer purchasing power, since this is what fuels consumer spending. Consumer confidence, this is something that typically is a solid indicator, especially for larger discretionary purchases. A car, for example, when the consumer is afraid or has low confidence, this is a purchase they usually end up postponing. But also interest rates. These affect mostly big-ticket items financed by debt, but especially in rate-sensitive countries like Finland, where a lot of household mortgages are tied to short Euribor rates, this is something to really keep an eye on. Usually, the higher the unit cost of a product is, the more cyclical the demand for it tends to be. However, in this relationship, there is a kink. And that's due to, once your customer base really is focused on these higher income households or consumers, and you produce luxury items to them, that usually ends up being an exception to the rule, and they tend to be less affected by economic cycles in their demand patterns. But if we think about the last few years for these consumer goods companies, here we can see the European Commission Consumer Confidence Indicator Index from a very long time period. But if we zoom in the last few years, we can see that there was actually an obvious peak in 2021, which really was a superior operating environment for a lot of these consumer goods companies. However, the consumer confidence dropped in Europe very rapidly, and 2022 was a difficult year for a lot of these companies. From there, fortunately, the consumer confidence has somewhat rebounded here in Europe. Coinciding with the peak of consumer confidence were also very low interest rates we enjoyed in 2020 and 2021, but from there, the short rates, interest rates here in Europe, the 3-month Euribor and 12-month Euribor, for example, shot up very rapidly in 2022 and 2023. From there, the Euribor rates have been coming down, and this is something that really supports the purchasing power of households with mortgages or other household debts. Going forward, I feel like if this trend in dropping Euribor rates keeps on coming down, we'll see this really supporting, especially the more discretionary consumer goods companies. But here we have some KPIs of the 7 listed consumer discretionary companies I presented earlier on today. Here you can see that 2021 was really a very strong year for these companies. These are the averages of their growth rates and the median of the growth rates. After an extremely strong 2021 year, the group's performance stepped down in 2022, and 2023 really was a bottom of growth for these consumer goods companies. From there, the growth rates have somewhat rebounded in 2024, and we expect this rate to pick up in 2025 and 2026. Also, looking at the returns on invested capital of these companies, you can see a similar trend. 2021 truly was a very strong year for these companies. Their returns on invested capital dropped from there, and even 2024 has been a tough year for these companies. We, however, expect that a strengthening macro environment is going to allow these companies to improve their performance from here going forward. If we look at the share price performance of some of these companies, here to the left you can see indexed share price development of these companies. If you would have made a basket of these 7 companies, this would have outperformed the OMX Age 25 or the Helsinki 25 index. However, the performance would have been very reliant on 2 high flyers, namely Harvia and Marimekko. To the right, you can see some of the EV/EBIT multiples of this group. As you can see, at the beginning of the period in 2018, these companies were very conservatively valued with realized EV/EBITs of only 10 to 11. From there, they expanded quite a bit to 2021 in a very strong operating environment. So these companies their profitability was on a high level, but also their valuation multiples were high back then. And that has compressed to a certain extent. For a lot of these companies, both the multiples and the profitability levels have come down from there, which explains a lot of the weak performance of some of the companies. From here, we see, however, that the valuation levels are on a reasonable level, especially considering that a lot of these companies still have profitability levels that are somewhat compressed. But that's all for my behalf. As a reminder, if you have any questions regarding these companies, you're free to state them as we go in the chat box. But thank you for my behalf, and I would like to welcome Elina Anckar of Marimekko to the stage up next. Thank you.
Hello, and I would like to explain you how we are scaling up the Marimekko phenomenon and the growth. And if we look at the Marimekko, the history, the company has been a value-based company from the very origin when it was founded in 1951. And our very meaningful mission has been to empower people to be happy as they are and bring joy to their everyday lives through bold prints and colors. And I would say that is so timely in this current world turbulent what we are living in. And if we look at the company, we have been a lifestyle company from the very get-go. So from the very start of the company, we have had the 3 product lines. We have fashion, bags and accessories and home. And this has proven to be a strong point for us because it also helps us to mitigate through different kinds of consumer demand cycles and situation and economical cycles. And if we look at the world of Marimekko, we have main markets, which are Northern Europe, Northern America, and Asia-Pacific region. And we are currently selling our goods in 40 countries. And as you can see, we have some 170 Marimekko stores globally, and we are working in each of the markets from so-called key city strategy point of view. So we are building key ecosystems for our clients in the key cities of all these markets. Then when we deep dive into our distribution strategy, you can see here in the middle of the strategy, the direct to consumer. For us, it means omnichannel retail. It is both the online and the physical stores, and those can be operated by ourselves or with our loose franchising partners, which is a distribution model, especially in Asia. And the beauty of this model is that our loose franchising partners are covering part of the business risk because they are investing into the store operations and the CapEx, even if we are working very closely together with them. On top of the direct-to-consumer distribution channel, we do operate in physical and online retailers, and we are extending our reach over there. The reason why we are also present there is that we want to gain share, but also access to new customers who have maybe never come across with Marimekko before. So good examples of those kind of channels, I could mention Nordstrom in North America and Zalando here in Europe. And on top of that, because the brand awareness is really key in our business. So we have these strategic global and local brand collaborations where the main target is to get brand awareness. And those are they're like limited time collections or product releases. But that is a key to get more brand awareness. But of course, on top of that, we get some licensing income. And we do have also traditional licensing where we complement our offering in such a categories of products that we don't otherwise are not present. The good examples could be eyewear or then bed linen in different markets. There are very different sizing in the bed linen in different markets. And if we look at the strategy period that we are currently in, so our strategy is called Scale. This is the third year of this strategy period, where we are scaling up our business through a proven recipe of success. And we have identified 5 strategic success factors for our company. And it starts with S, very fittingly, because it's called Scale Strategy. And there we have chosen the sustainability. We really believe that the efforts do support us in the long term as well. The second one is sharpen creative vision. And the reason is the fact that because we are in a trade of desirability, the key of the success is that product is desirable. So really working on being even more sharp in terms of the creative vision and then speaking for a wider global audience, meaning larger consumer groups and consumers. Third one is accelerating growth in Asia, especially in Asia. Of course, we are seeking growth everywhere. And then the fourth one is love for Marimekko life, meaning the brand love, building more communities for us. And the third one is linked with the end-to-end digitality, where we see opportunities to boost our omnichannel growth and then also build efficiency gains throughout our value chain. And now I want to deep dive a little bit more in what we've been doing recently in these different strategic success factors. And in this particular slide, I would like to lift the fact that our sourced materials, when we are looking at them, nearly 60% of the sourced materials are recycled, organic, or regenerative materials already now, meaning that they are lower emission materials. And we are continuing on this work and investing into more sustainable materials. Then you can also see that We have there the Marimekko Maridenim products. That's a product family we launched last year, and it was designed already from the very start on principles of circularity. So our designers were already thinking that what would be the easiest way to make sure that when the product life cycle is at the very end, how it's easy to be recycled. So they were thinking about the buttoning and seamings and the materials and how do we even print the flowers to the or whatever patterns there currently is to the denim. So it was from the very get-go. And a couple of words about how do we then reinforce the product desirability and make sure that our product is even more relevant internationally. And we have been building so-called hero products and hero programs. And a good example here is this all-day wear bags, where we actually have this product family when we introduce seasonal colors once in a while into that to freshen up the collection. But then we have like products which are continuing there all of the time as well. We have been working in the category ownership, and as mentioned already, Maridenim is a new category that we have launched. And there also we are looking into the product life cycle and what is the strategy in overall in there. And then on the right-hand side, you can see products which are linked with the Chinese Lunar New Year. It is a consumer moment, very, so to say, like we want to be more locally relevant, especially in Asia. So we are building these local consumer moments. On top of that, we are increasing the modularity of our collections when we are building the collections. And then a couple of words about how we are accelerating the growth in Asia. And as you can see from the text, so last year we opened 14 new stores, of 13 were in Asia. And on top of those stores, also 19 pop-up stores, which were like for a shorter period open. And if we look at the Asia and overall, we have 90 stores in that area. So that is the largest number of stores in any market area. So that is our biggest market area number of stores at the moment. And then if we deep dive a little bit further, what else? I mean, what do we do otherwise? So we are present in some 10 countries in in Asia at the moment, of which Japan is the biggest market, where we have some 40 stores. Then we have Greater China, 25 stores, and then we have Thailand, some 14 stores. So you can see that we have already quite diversified presence in Asia. But then when looking at our current footprint and then thinking about the size of the markets, we do see a growth potential also in a long term in this particular market. And if we then go into explain a little bit more, how do we build the brand love? So we have a very value-based, unique brand position. So we have a value-based brand story which is built on optimism, and in the heart of the brand we have the art of the printmaking. So thinking about, we have 3,500 prints in our archives, and there are coming new prints all of the time. So those are in the core of our brand. But how do we actually build our community? So you can see some of the examples here. So we have a proven recipe of utilizing the brand awareness, which brand collaborations, which I talked about it, but then we are building brand moments and community events that then are also producing content for social media and then also for a wider like paid media. So this is the way to reach more people and consumers all of the time. And you can see there our Esplanade fashion show this spring, where everybody were invited. So that is very inclusive event, and it had a record audience this year, so over 13,000 viewers. So that is an example of how do we actually build the brand awareness and our community. Then a couple of words about the in terms of the end-to-end digitality, and I would like to highlight here our new e-commerce platform, which we have introduced and we have taken that into use. So we've been working on that platform for a while now. And in terms of the technical point of view, it is a very modern, composable architecture. In terms of the consumer experience, it's more personalized, more competitive in terms of the speed, and then also the consumer experience. We are utilizing different kinds of AI features there. So AI visual merchandising, then we're using AI large language models in a Q&A session for our consumers to actually make them to be more satisfied. Then very few words about how did the first quarter go. So it's we continued our profitable growth in the first quarter, and you can see that our net sales increased by 5% in the first quarter, but we had some time-related factors which were present in the year before, which were, so to say, like impacting this current year's performance in terms of the sales. Comparable operating profit on the seasonally smallest quarter was at a good level and 11.1%. And then regarding our financial guidance for year 2025, we have reiterated that. So we are expecting our sales for 2025 to grow from previous year and the comparable operating profit margin estimated to be approximately some 16% to 19%. But of course, like rapid changes and uncertainties in global trade policy and development of the consumer confidence and purchasing power in the company's main markets, as well as any kind of disruptions, cause volatility to the outlook of 2025. But I would actually like to end here looking at the long-term financial goals, which our board set only in the second half of year 2022. And we are targeting strong profitability by scaling growth. And as you can see, the annual growth in net sales target is 15%. Comparable operating profit margin 20%, and ratio of net debt to EBITDA at the year-end max 2. And we have been a more or less debt-free company, so that of course, like as you were talking about, look at the balance sheet and the possible impact of the interest rates. And then the intention has been to pay yearly dividends. That is our dividend policy, and the percentage of EPS at least 50%. And once in a while, we've been also paying extra dividend, like from the year 2024. And the reason behind this is our strong financials, then also due to the fact that we are sharing the capital expenditure investments with our loose franchising partners, and then also that our scale strategy is built on profitable growth.
Thank you,
Thank
Elina
you.
Anckar. Please sit down and join me for Q&A.
Yes.
So we do have quite a lot of questions here already, but if somebody in the audience still has questions, please feel free to submit them to the chat box. But if we start off, Elina, with brand.
Yes.
Because everything about Marimekko ties so strongly into a brand. How do you feel? What are the keys to building brand appeal in foreign markets? Because that's where you're mostly growing nowadays.
Yes. So of course, it's all about the awareness that the consumers know that you exist. So that's the reason why we are building so much about the brand awareness. But then even if your consumers are aware that you exist, then you have to have a product that they really want to buy. So then of course, it's all about the product and our ability to cater for such a products that they really want to buy. So it's combining those two as well.
And since you're a very global business, are you seeing some clear differences in trend about how to build that awareness regionally, and also what kind of products consumers are interested in?
I would say because we have been building our company on these 3 product lines from the very start. So it's also like building your own story, but then at the same time be fully aware what is relevant in each of the markets. So when we are building our collections, we are of course taking a feedback from the markets as well. So that is like a loop for our collection building and our creative vision. So it's of course we are a design company, so we are the ones who are designing the products, but it's a feedback loop is relevant as well.
And you have been very diligently building on this Marimekko brand, but how do you see, would there be room for another brand within your product portfolio?
As you said, like we've been having this Marimekko brand so far. I think the strong point of having a one brand is like of course it takes time to get your message through, and it's easier when you're concentrating on one brand. And our products are very well fitted under the same brand, so we haven't been in a situation that we need to think like why wouldn't we add it? So it's like having this mono brand is our strategy that we have chosen from the very start as well.
Yeah. Do you feel like having this mono brand strategy constrains you with some decision making, or is it only benefits so far?
I would say that it has been benefiting us, yes, because it's, as you said, it's all about getting your message through and reaching your customers and teaching them to learn that you exist and what kind of products. And of course, it's like then combined with our value-driven stories and everything linked to that as well. So,
got it. But with the brand, since you're taking somewhat of a premium positioning, how do you manage to grow efficiently, like globally grow your revenues and sales without diluting the meaning of the brand?
I think it's very much about like, then you mentioned very well, like we are premium brand, we are not really a luxury brand. So we are premium brand positioning, so it's all about in any of the categories, you need to make sure that the product and the pricing, for example, is something that the consumer finds fitting. Yeah. So you need to be very smart in terms of the pricing as well. But it's, as I said, as a CFO, it all starts with the fact that you measure what you get. So you get what you measure. So very rigid follow-up in terms of like your sales targets, your margin targets. You make sure that your growth is profitable.
Yeah. And how do you feel, do these different brand collaborations support you with this, like keeping this high brand profile?
As it is, whatever we are doing, what kind of brand collaborations we are doing, it's always really, it's a decision that is done with that we really think with which brands we want to collaborate. So it's not something that we would collaborate with anybody. So it's very well thought process. And then as we, it's also about us sharing similar values. Yeah. So it's both brands are building from that perspective each other's. But then it's also that with, for example, like this brand awareness that you would see, like if I say, for example, like with the Uniqlo, we have had the brand collaborations, thinking about the number of customers we are reaching via them having their our products in their stores and in their web store, and that awareness. And they are doing the brand collaborations in a similar way with the kind of like similar kind of brand positioned companies like us, or even with luxury brands. So it's like a natural setup that where we are playing with them.
So what kind of collaboration partners are the most interesting for you in brand collaborations, or what are the maybe key points that get you on board with this?
I would say it needs to be something exciting as well. It needs to be something new as well, something that you wouldn't like expect, for example. But then if we think about our brand and our bold prints and colors, because that is bringing us a really good asset, because it's quite easy to like combine with any kind of product. So it's about like us choosing something that is interesting, exciting, and very relevant. So then thinking about the local brand collaborations outside Finland, for example, we need to know which brands are relevant for the local consumer. Like, for example, in China, we've done collaboration with the Hey Tea. It's a tea brand. It's like a China Starbucks. So that is very relevant in China, so we wanted to collaborate with them.
So could you say that one of the key principles is that you have to reach new audiences?
Yeah,
with your
yes,
brand?
yes. And then know your market.
Yeah.
Yes.
Got it. So in your presentation, you went through your omnichannel strategy.
Yeah.
Marimekko does direct to consumer, also utilizes retailers and has deep partnerships with these. So how would you summarize maybe the benefits and maybe even some cons to having this omnichannel strategy?
Because it's, as I said, like you need to know your consumers as well. So it's also about like knowing your consumers, getting the best locations as well. Yeah. So it's all about the location when it comes to the retail. So you need to know like what are the best locations and then also what are the relevant e-commerce channels. Like for example in Asia, like direct e-commerce is not so often, it's not so usual. So for example in China we operate on different platforms. And then when it comes for the reason why we have chosen, for example, the loose franchising model in Asia, it's very much to do with the right location. So we have partners who have other brands than us as well. So they have more negotiation power with the landlords. They get the best locations, and then they have like more knowledge about the local market. So for us, it has been working well. So we are working and expanding with the partners.
Yeah, so you utilize your partners' strengths whenever.
Yeah, exactly.
Yeah.
But then on the other hand, in the markets where we think we want to operate our own retail ourselves, then we just do it ourselves. So we have the both, so to say, models, but working very well together.
How about your stores in Asia? Do you have like special training programs for these sales associates there?
Because the majority of the Asia Pacific stores are run by our loose franchising partners. In Australia, we run our own retail stores, but we work very closely with our partners. So we are like swapping the best ways to run the business, and as we do have training programs for our own stores, so could also think that I know that they do the same for their people as well. And then we, for example, the brand experience, the visual experience of the stores is something that we build together. So it's a very close connection. And of course, the sales associates' ability to serve the customer is very key in our trade as well. So it's the first contact, or maybe the only contact for the brand as well.
Got it.
And same goes for e-commerce about like how fast and how user-friendly the platform is. And that's why I wanted to lift it in my presentation.
I can imagine that. How about with your potential partners? Do they usually approach Marimekko, or are you the one reaching out to them?
Would say that we have quite long relationships with our partners. So it's about like... It's a question that it's an interesting question. I've sort of started to think that how does it go? I mean, if you go for a new market where we haven't been, I mean, of course, it's more like choosing the right partner. But I don't know the history how the very sort of like it started with Marimekko, but must be both ways because you need to find the best partners. Yes.
And maybe before. Well, I'll let you go. I have to ask you one question about US tariffs.
Yeah.
I can't let you off the hook with this one since it's so topical right now. But how would you see Marimekko's exposure to these current tariffs?
Of course, like we are similarly exposed in general, like anybody who has a business with US. For us, then of course, when we look at our annual turnover and share of North America, it was last year only 6%. So from that perspective, we are like, the exposure is 6% of the turnover. Yep. And then on the other hand, when we look at because we're working globally, so we have a quite well diversified supply chain on the other end. But
So you're
Of course, like following very closely and doing needed mitigation actions.
So you could say that you can make some adjustments here and there to react to it, but at the same time, it's rather, well, a small exposure to that market.
Yeah, in direct exposure. But then, of course, like in terms of the consumer confidence globally and the purchasing power of the consumers, we have to be smart with that view as well. So
yeah. Before I let you go, maybe I could ask one question about growth.
yeah.
Since you have this growth target of 15%, how are you? Well, what are the keys to achieving that?
Yeah.
And since historically your growth has been organic, what's your view on inorganic growth? Your balance sheet would give you firepower for that.
So far, we haven't done any M&A activities. Regarding the long-term 15% annual growth, we have, of course, the levers behind it. So it's in overall like growing also the existing stores, existing communities, then expanding with the help of e-commerce. We do believe growth, we are able to grow in home market Finland as well. Then in Asia, due to the size of the market and our current footprint. And then we've said that we are looking into new markets as well. And then, of course, like we could think about other categories, licensing categories, and then in overall, like growing our community as well. So,
yeah, and all spearheaded by the Marimekko brand.
Yeah.
Thank you, Elina, for the Q&A. I hope you the best.
Thank you very much.
Good afternoon. My name is Alexander Rosenlew, and I'm presenting Orthex, the Finnish consumer goods company. So a few slides first on who we are and what we are doing. Nordic has been for a long time our home market, and now the horizon has lifted and we're focusing more and more on growth throughout Europe. Today we have sales organizations in all the Nordic countries and then on the biggest markets for us throughout Europe. And we are present with 3 strategic brands: SmartStore for storage, GastroMax for kitchen products, and then Orthex, the company brand mostly known in Finland. If we look at the footprint, today we operate 3 modern factories in the Nordics, and they are highly specialized and automated, and this makes it possible to produce efficiently in our own countries up in the north. And these are clearly all certified, and we are proud to say that about 90% of our products are produced in these facilities. This gives us a bit of an edge in terms of ensuring end-to-end sustainability throughout the whole process, from product development, own production, and then the quality is ensured at the customer, and finally, hopefully the consumer is happy with what they get. We also have a distribution center, a warehouse on the border between France and Germany to serve our customers flexibly, efficiently, and in good quality and time. So looking at what we've become over the years, the mission is very clear. We are there to provide an easier everyday, and if we can do that through practical products that fulfills a need, that solves a problem in the home, then we have come a far way. So always when we look into product development, we're not into the things that are just there, we're into the things that help everyday life. And especially storage solutions is a field where we believe that we can with a very good and broad portfolio of products, we can help the everyday life and the everyday needs of storage. Kitchen products, our second category, about 20% of sales, is quite a lot about food storage as well. So there's a clear link to the storage category and quite often the same shelf and the same buyers in the stores. And then we have the last category, which includes home and garden products, flower pots, etc. So what is interesting here is in our strategy, we want to achieve about 10% turnover coming from new product, keeping us alive, keeping us current and following the trends. And that, of course, creates quite an important job, which is also cutting the tail. And there you have to be extremely focused not to put your production units into problem and your warehouse is too full. But for us, the long-lasting products, the quality of the products are key of what we are doing. And this is somewhat against the trend of low price, low quality that is prevailing at least today when the consumer is more and more careful. So I take the opportunity to discuss the start of the year, and that's actually quite, I hope, interesting for you. Most of the consumer goods have had a bit of a tough time, and that's of course linked to purchasing power, to geographical and macroeconomic challenges, which in themselves makes consumers sit on their money and not spending too much on the products. And this means that there's a tough competition from low price alternatives, but we believe in the end by being consistent, by building brands, by being the best offering, the best solution to many needs, you can actually overcome these. But it's a long-term game, not a sprint. Then if we look at what we've done, we've been extremely tight on the fixed cost. Of course, since our factories are so far automated, our structures are in place. We have not cut on anything that could prevent future growth, but we have been very, very cautious on where we spend the money. And the money is spent today in the stores on new product to drive future success, future growth. I would say the outcome at the start of the year, always hopeful when a year starts. Looking back, we are a bit disappointed. There are a few quite clear reasons for it. There are many success stories as well, but there are some customers, some collaborations that didn't work as we had hoped for. In the end, we've had a healthy cash flow and we have a strong balance sheet, which actually gives us room to maneuver and find future growth. So looking quickly at sales, we were down a bit, almost 5%, and we would attribute this to negative consumer sentiment and actually a few retailers, especially in Europe, having very hard times paying their bills. So we've been cautious in shipping and that has slowed down the momentum a bit. When you have a lot of cost related to your structures, as soon as the sales are falling, it means that a little bit less flows through, however, posting a positive EBITDA at 1.7 million or 8.2% of turnover. Cash flows strong in the quarter. Then I won't go too much into the geographies and products. This is just a visualization that Nordic is still the biggest. Clearly the ambition we have is that what we call here rest of Europe pillars will one day be, let's say, in an opposite way than they are in this picture. And that's where the focus is. A bit sad that temporarily we had a bit of a hiccup in Q1 due to a few customers and losses related to sales, not credit losses, but carefulness in actually shipping goods to customers that were unsecure payers. And there has been a strong push to compensate for clearly the weak consumer takeoff. Looking at the strategy, which is still highly relevant for us, It's built on 3 boxes, 3 very clear boxes. The number 1 is to grow in the Nordics, in our home markets. And that's from time to time a bit tough, especially when consumer sentiment is down. That's the place where we then need to focus on bringing new interesting products. And yes, that we are doing. And focusing on the category, focusing on actually helping our retailer partners to be successful in the whole category. And if we can be meaningful to our retailer partners, our long-term partners, they will select us to be there in the shelf. And that's our ambition. And we're, of course, very thankful for all those long cooperations. Then the number 2 box, which is, to me, the biggest opportunity, and that's accelerating the growth in Europe. We are already having quite some significant, big, interesting customers. But we are, with many of them, in a phase where we have a quite small assortment, when we are not in all the stores, and where we don't run national campaigns yet. So the ambition is to deepen the cooperation with the customers that we have opened, let's say, during the past 1 to 5 years. And that should give a good leverage on what we are doing. And then we have the online retail channel, where we are present on many platforms and present on many of our traditional customers' online platforms. We're not doing it ourselves. Logistics to consumer is not our best practice. It's not our best asset. So we'll give that to the experts to handle for us. And then there's the looking for a suitable partner in Europe, which we are, I think, doing all the time. And hopefully at some point there's something to tell as well. The ambition here is to be the number 1 storage brand in Europe and continue as a leader in the houseware segment in the Nordic countries. Just to give you a picture of who our customers are, maybe some familiar brands to you. These are just some examples. There are many, many more customers we have, but just wanted to show to you that we are operating in basically almost all of the different formats of chains throughout Europe and the Nordics, from discounters to e-com to DIY. For us at the moment, the DIY, specialty and grocery are where we have, I would say, the strongest foothold. But we have also some really good cooperations with retailers where our products are well displayed and can be sold as branded goods. So what drives success? I think what we can do for our partners is actually we can know everything about the category. We can know exactly what products should be in the shelf to make shopping easy. We can be the one which is the best in delivering on time with quality and speed. And then bring a lot of new product that brings new growth opportunities for our retailers. So we put a lot of efforts into everything which is behind the product and not necessarily visible to the consumer, but we want to be the expert in the whole business, not just selling products at a cheap price. So when things are as they are, and when you need to cheer the consumer up, then it's a good time to have a party. And actually this year, the classic Smart Store box turns 30 years. I believe we were the first one that had boxes with clips that could close the lid firmly in a qualitative manner. And we are quite proud to say it. Nowadays, this is almost standard in the category. So we have to keep inventing, we have to keep freshening up things, but from time to time it's nice to look back and celebrate what has brought us many years of very good growth up until now, and I'm pretty sure going forward as well. Then always a few words on sustainability. There's a lot on this slide. I think the main building block in our approach to sustainability is that if we can create long-lasting products that you don't need to throw away after a few uses, then you are quite far already. And the target is clearly to reduce the carbon footprint we have. And if we can do that, we actually help. From a helicopter view, we help the climate warming from speeding up. So that's, to us, that's key. And the biggest impact is clearly the raw material we use, and therefore for us it's really important to include recycled or bio-based raw materials in all products where you can do it according to legislation today. And of course, with all the greenwashing going on, we spend a lot of time in actually having third parties to ensure and to show, and that we have the documentation that what we are claiming is actually completely true. And this is important to us because if you say something, you better stand behind it, and that's why we take some pride in actually spending quite a lot of resources to make sure that we can be certified in different ways for our sustainability efforts. On the innovation side, I think there a few words. A lot of new products. During the COVID time, we invested heavily into our production, into our capacity in the factories. We maybe even overdid it, so we have quite a good capacity now to work with. So we have been able to channel quite a lot of our investment into new product, and this is extremely exciting to follow the trends, to see what's needed, also to sometimes fail and realize that okay, this was not good. Then you have to be quite quick and just realize okay, this was not that good. Let's move it aside, let's focus on something which is better. Having said that, a mold investment is always a very big investment. To make a product, you require a quite big handmade steel mold, which takes time to produce and a lot of money to acquire. But just to give you an idea of what actually we are for our partners. We are not only a supplier, we have a lot more to offer. We have a long experience. We know very well the categories. We have the insight, we do the research, we have the offering, we know how to put it into shelf. We can provide the goods on time, complete, and also quite usually faster than competition coming from the Far East. We work hard on sustainability. We focus on building strong brands that consumers want, and we have a wide range of products to offer, often with award-winning designs. And this is, of course, the story that we want to tell the buyers at the big retailers, and when they get what actually we are doing, collaboration usually becomes quite much more rewarding. Then just a quick jump into the financials for Q1. I said that sales were down a bit. They were down by about 1 million, and when the top line is a bit weak, when you have a very automated and actually quite far fixed cost-based operating model, it will flow through down on the bottom line, and that we've seen in terms of the profit not being exactly where we wanted. Having said this, I strongly believe that the other way is also there, meaning that when we have a bigger growth, we have capacity for it. Actually, we would, or I would personally be surprised if the relative margins wouldn't be better. Then looking at one of the interesting parts in our business, and that's of course the raw material price. That's the biggest cost we have in the products. As we are so automated, actually the salaries are quite a small part of the end product's cost. The raw material had a huge peak some years ago. It went up by almost 70%, came down again. Oil has been going down. But in Europe, the raw material prices have not gone down as much as in other places of the world at the moment. Even though the demand for raw material is quite low due to general carefulness, auto industry in a bit of a challenging situation, etc., etc. So we are hoping and expecting that at least the price wouldn't go upwards. For us, a stable trend is always interesting because that's something to build your assumptions on, but not giving us any major favors during the period. In terms of investment, here are the latest ones. I just wanted to point out the leverage at the moment. The balance sheet is at 1.2 net debt to EBITDA, and that gives us plenty of room to maneuver. And the targets we have still there, still the same. We are in a strategic period now, looking at the targets, looking at perhaps refining them, and we'll come back once that's ready. But for sure, still growth target overall and fast growth outside of the Nordics. So full focus on sales growth, and then of course one day we hope that the consumer sentiment will be a bit more positive, so we can have some wind with us and not only rain in our faces, as today in Helsinki. Thank you very much.
Thank you, Orthex CEO Alexander Rosenlew, for your presentation. Please join me for a Q&A.
Thank you.
So, starting off with growth. You've been with Orthex for quite some time, building the story from a Nordic company into a European player. What do you think are the key insights you've learned along the way?
I would say stay true to what you have and what you do, and be quite consistent. I think the guiding star we had that we are making a quality which is slightly better, and we want to improve the consumers every day. I think that's one of the key things. And then one learning that came quite in the beginning was you can't be best at everything. I mean, choose where you are good and be really good there. That, at least to us, has been one of the recipes.
I can imagine having a high quality and being good at what you do. It's something that works here in the Nordics, but Europe and the rest of the world as well.
I believe so.
How do you teach consumers into appreciating quality in a category like storage where, well, you might be competing with IKEA boxes, for example?
I think it's about trial, and I think a very good way of seeing it is that usually a consumer who has bought one of our boxes, and they're often modular, usually that consumer comes back to our brand if they have used them once. And we can see that especially now that you get all the statistics out from e-com, you can see the conversion rate of a shopper if he or she comes back to buy the same type of product. And I think there we are clearly, when we get the product to the end consumer, we are beating competition.
So you have to get that first Trojan horse into the consumer's apartment, and
that's one way of saying it. Yeah.
How do you see your multi-brand strategy? You have multiple brands, although SmartStore is the spearhead for European growth. What do you think are maybe the strengths and maybe some downsides to this approach?
I think looking back at our at some stage in our development, when we had acquired two Swedish companies, I think we had 9 brands.
Yeah.
And we cut it down to SmartStore, Gastromax, and then Orthex. Orthex is clearly sort of the traditional Finnish household name since 1956, and I believe that any person who is born in Finland and is my age, I don't know about the youngsters, all of them, but many of the people, they would know Orthex by heart. So that's an excellent company name for us. But then it goes well into the home and yard category as well. If you think about SmartStore, it has become a real brand, and it's becoming big enough to actually support the brand with media, with visibility, with influencers. And I think Smart Store translates very good into the storage category. But I think we would have a hard time putting it on, let's say, kitchen utensils like frying spatulas or things like that. So that's why we have the Gastromax brand left in our pockets.
So you could maybe conclude that some of your brands just don't expand into these certain categories you're active in.
We could say so, and especially for Smart Store, it's a certain sort of niche that we want to operate in. And what we did not that long ago was actually we moved the food storage branding from Gastromax into Smart Store.
Yeah.
And that proved to be a quite good move actually.
Okay.
And it translated good into that.
Yeah.
So it's clearly the spearhead.
So are you seeing consumers buying both Smart Store storage boxes and food storage?
Yeah, absolutely. And then when we talk to retailers about shelf space or campaigns, etc., it's so much easier when you have it all under the same brand.
Yeah. How about thinking about your brands? Do you still see room to expand them further into new categories they're potentially not active in right now?
I think, I mean, they could stretch a bit.
Yeah.
They could stretch, but not too far. Okay. I think there are rooms still where you have kind of storage needs which are not directly boxes, where you could think that Smart Store could be a really good brand.
Okay, so a careful yes.
A careful yes.
How about, well, whenever we host these events, I feel like there's always this question popping up about M&A. And here the asker would like to know, what kind of companies are you looking for in M&A, and how does the pipeline look like?
Yeah, we are actively looking for a foothold on mainland Europe, and if that foothold includes additional production capacity, if it includes access to new customers, and if it includes, let's say, at least some products that could fit into the quality image that we want to convey, then I think we are close to a good fit. And then if the price is right in the end as well.
Yes, and I could imagine you'd prefer the target being somewhat automated when it comes to their production lines.
It would be good. On the other hand, we could bring in our know-how into a factory which is on a different level today.
Yeah. Piggybacking on that comment about bringing in know-how, how active are you as an acquirer in the sense of integration?
Meaning that how active we are looking, or
how well do you integrate, or how in depth do you integrate a acquisition target into your operations?
Well, I think the previous two acquisitions we made, what we actually did was we turned everything around. We had 3 production-driven companies, not focusing too much on consumers, not focusing too much on brands. And we actually built a whole new way of operating as one company with the same ERP system, with the same way of operating throughout the organization. It takes a long time, but once it's done, you can become stronger.
I can imagine you're able to cut off some costs that are, well, on multiple different companies.
You should be, and then I think if you want to be really good in something, then it's better if the whole organization goes the same direction, and share the same sort of vision for the future.
What do you feel are the main benefits you would get out of being closer to your key clients through M&A?
Yeah, I think still, I mean, we are talking quite bulky goods, and we are talking retailers who have big shops and don't want to keep inventory.
Yeah.
And they would prefer, I mean, fast deliveries, and we would prefer fast and cheap deliveries.
Yeah.
And then clearly, I mean, with the growth, with the additional capacity that we could get, are all important things.
Yeah. Yes. Here we have a question regarding M&A, but could Orthex be an acquisition target? I think you have to be careful here what you say.
I don't know. I mean, I don't know how to comment on that one. I personally, of course, I love my company and I think it's a great company. Then you never know.
Yeah. How about you've struggled lately with some weakness with your, with some retail partners. What are the main causes of this weakness or their current struggles?
Yeah, I would say that there's a bit of a battle going on the retail scene at the moment. You have some discounters doing extremely well throughout Europe, and you have some concepts that somehow have lost attraction for the shopper. And I think those who have lost attraction for the shopper have had quite hard times when overall consumer confidence is low. So the traffics that have been declining sharply lately. And if you are highly leveraged, then you might have a hard time paying your bills. So it's related to this.
Yeah. But I can imagine even with the performance of your partners varies quite a bit, that there's some strong winners currently and some struggling with this.
Yeah, you're right. However, I think this 1 to 2 years have been a bit different from the usual. I think there has been more struggle in different retail chains. We've even seen bankruptcies on the market, but it's some kind of renewal, and I think e-com might be related to this as well, and consumer awareness of pricing and of assortment. And if you don't have what the consumer wants, and the consumer can see that somebody else has it, and today you can see it so much easier, so you will travel the extra mile to get what you want.
Yes, and e-com seems to be an increasingly growing trend still after the, should I say, Corona hangover. So how do you see any differences in profitability from your point of view between brick and mortar and retail and e-commerce partners?
That's a tough question. I would say in the pure e-com, it's a different game than in the, let's say, multi-channel where you have both brick and mortar and e-com. But in the pure e-com, I think you are able to get to good profit margins if you know what you're doing. Yeah. If you know what drives the purchase, if you know how to invest wisely, you can also completely destroy your margin if you try to pay your way in the wrong way.
Yeah. So you have to balance between growth and profitability in that sense.
Yeah, and then I think players like Amazon, for example, there are so many ways that you can invest in their marketing programs. Yeah. And there are so many parts of the marketing program that is not delivering you anything.
Okay,
so it's a learning, and it changes all the time.
Yeah. Some of our viewers have obviously paid close attention to what you said, and quote, you mentioned that there's a strategy process ongoing. Is there going to be a capital markets day in which the company's new strategy is going to be launched?
That's the intention. I believe so. It's time to. I mean, we've been listed now for a few years, and we've followed the strategy. It's clearly working. We are happy with the growth pillars that we have. We know we can grow in Europe. Yep. We know we can accelerate it. But I think it's time to go out and tell a bit more broadly about, for example, the next coming 3 years.
Okay.
So hopefully in H2 we'll have the opportunity to speak a bit more about it.
So there might be the opportunity to refine it a bit around the edges.
Yeah, I think you need to do it. I think you need to be agile because the world is changing fast, and even though you have your ideas and your thoughts on everything that you should do, you should always challenge yourself and ask, I mean, are we doing the right thing now?
Yeah. Well, you mentioned how the world is changing, but if you look at Orthex 5 years out from now, what excites you the most? It goes beyond the upcoming strategy period as well, it seems.
It goes beyond, and therefore, I mean, I can put in only my personal view on it. And looking back, I've been in this position, which of course has changed a lot during the time I've been here. I've been 15 years already, which is quite a long time. So I've seen the company go from, I think, 12 million to closer to 90 today. And if I would take that and look back, okay, we have 5 or 6 doubled the sales. of course, my ambition is to continue to grow. I think that's fun. It's rewarding, but we have to grow profitably so we can invest into new interesting products. We can invest into new geographies. I think hopefully one day, if it's not me, maybe it's someone else who says that Europe is our home market, and now it's time to take the step into, I don't know which continent for real.
Yeah. But first, there's a game to finish here in Europe.
There's plenty to do, which is fun.
Thank you, Alexander Rosenlew, for your participation in the Inderes Consumer Goods Night.
Thank you so much, Thomas.